What a blockchain nation. So it's been all over the news, the demise and the fall and the end of the entire financial system. Well, maybe that's a little bit of an exaggeration, but really want to talk about Silicon Valley Bank and what's unfolded, how it happened, and what my thoughts are on what we, or my opinion on what might come next, or what we should do next. So welcome to All Things Blockchain, and get ready for the ride. So Silicon Valley Bank was arguably one of the largest banks in the United States. It was rated by Forbes as one of the top 20 banks in the US. Between 2019 to 2021, they raised millions of dollars in deposits from investors. So pretty much 50% of all USA startups have deposits in Silicon Valley Bank, which accounts to about 65,000 companies. Just to give you perspective, companies like Lending Club, BlockFi, Roblox, Roku, ClickUp, Vimeo, and the list goes on and on and on and on. Pretty much half of venture-backed startups keep their money at kept their money at Silicon Valley Bank. So what's happening now is really frightening for a lot of people. So how did we get here? Prior to Silicon Valley Bank becoming insolvent, Silvergate Bank had a similar issue where there was a run on the bank, which is what happened to Silicon Valley Bank, and I'll go into details about that. But Silicon Valley Bank, or Silvergate Bank, was tied close to FTX and Sam Bankman-Fried. Did a video about that, you can watch that here, and their relationship to FTX is kind of what caused their demise. Anyway, so what happened to Silicon Valley Bank? Pretty much, first was the pandemic, second was government spending, and third was interest rates. So during the pandemic, of course, it was locked down, nobody was going anywhere, and to stimulate the economy, the United States government decided to spend over $2 trillion in stimulus checks, which made available to people to help them out in trying times, people losing their jobs and all that was going on in the pandemic. Second thing that happened was they dropped interest rates. Now, by dropping interest rates, it made money easy or free or cheap for major companies to take loans at 0% interest, probably use that to buy back their stock or to invest in other companies. So my point is, so what happened was there was so much capital around and there were so many investments going on. It was just like a free party for all. Everything was great. Now, a bank like Silicon Valley Bank that has deposits from all these major startups, what they do as a bank is they take those deposits and they invest those deposits into other ventures, and the interest that they make from those deposits, less the interest that they are paying depositors, is their yield or their spread or how they make money.
He picked up the check, he told Mark they'd talk again soon, and he was gone. But not before he made his biggest contribution to the company.
Drop the just Facebook. It's clean.
So Silicon Valley Bank, like a lot of banks, invested in two major investments. One was mortgage-backed securities, and the second was government bonds. This is very important, so you have to follow this part of the story. I'll try and make it as simple as possible.
Some big numbers coming out of the housing market today, and they're not looking pretty if you're looking to buy or rent.
Our house had 44 offers on it.
Demand off the charts, prices rising at the fastest pace in 15 years. But is the market too hot? Is it overheating? A bubble, as they say.
So United States, people who own homes, for example, you can have a house that costs about $350,000 over 30 years at 2.8% interest. You might end up paying almost $500,000 for that house. So the bank makes about $200,000 in interest in that 30-year period. And so what happens, what a mortgage-backed security is, they take loads of those mortgages and they package it as an investment and they sell it to an investment bank. So if you think about, for example, you have an interest rate of about 3% for 30 years and you have a $100 million loan value. So pretty much a company or a bank can make $130 million in interest, which is very attractive. And so prior to what happened recently with interest rates, newly issued mortgage-backed securities, probably around COVID, were not as attractive as the old mortgage-backed securities because the new issued mortgage-backed securities are about 0%, as opposed to 2% or 3% from older securities. But that was fine for the longest time. Then recent times, Jerome Powell, President of the Chairman of the Fed, because of inflation is very rampant in the United States, decided to increase interest rates. Now, what happens with inflation is, because like I said, one of my first points I mentioned was a lot of government spending. When you print out a lot of money, money loses its value. Money is a lot of things. Money is a store of accounts, it's unit of value, it's a medium of exchange. And because money had lost its value, that's why the price of things go up. So that's really what inflation is. So when you walk up to the supermarket and something that costs $5 now costs $7, it means that the dollar has lost its value, that it takes more of it to buy the same glass or same bottle of milk The milk hasn't changed, but because the dollar has lost its value, then you need more dollars to buy the milk. So back to mortgage-backed securities. And so because now interest rates have gone up, the newly issued mortgage-backed securities are more attractive than the old ones. So you have a bank like Silicon Valley Bank that has bought millions of dollars in those mortgage-backed securities for 30 years. But now you have newly issued securities at a higher interest rate, which makes the old one less attractive. So all their assets are losing their value. That's scary for a bank because they have short-term deposits, which means the customers can withdraw them at any time. But they have these long mortgage-backed securities they are holding for a long period of time. That ordinarily isn't a problem. If somebody walks into the bank and they want their money, the bank can always liquidate some of these assets and pay off that customer. It works fine, it evens out. But if everybody comes to the bank for their money at the same time, then that's a problem, which is really what is called a bank run. And so the newly issued mortgage-backed securities, for example, at 6% for 30 years, can land an investment bank $200 million as opposed to the old securities. So all the old securities lost their value. The same thing with government bonds. Exact same example. Old bonds are more attractive than new bonds because the old bonds have a higher interest rate than what was 0% during COVID. But now interest rates have gone up. Why would I want to buy an old bond at X% when I can buy a new one at the higher interest rates? And this bank had spent millions of dollars, about $80 billion in bonds and securities, which were worth less their value. Now, it wouldn't have been a problem if they had waited out till maturity. The bank is fine, but because what happened next was what really messed up the bank. In one day, the CEO of the bank made an announcement, talked about how they had lost value in terms of their assets that they were holding, which are these securities and bonds, and they were looking for ways to recapitalize, to sell some of these bonds, and which caused a panic. All it was what's going on, and the same thing happened with Silvergate Bank. And all of a sudden, you have people who are running for the bank, all wanting the deposits at the same time. And that's what happened to Silicon Valley Bank. They didn't have the assets or the liabilities, the customers' liabilities. They had to sell off their assets, and they didn't even have enough. And they were illiquid, and eventually, ultimately, they became insolvent. This is the largest, arguably, crash since 2008, and the second largest bank collapse in history. So where do we go from here? Now there are so many companies that cannot even make payroll. I think the after effects of this event, and I think this is just the beginning. I think it's not to be a doom and gloom guy, but the repercussion of this, I think we're still going to see the ripple effect of this. Signature Bank, which was a major bank that deals with crypto and crypto assets, has also folded up. The Silicon Valley Bank has also folded up, and now we have this today. So some of these startups will not be able to make payroll, which will be really, really difficult for a lot of people. And when that begins to happen, I think the long-term effect of this is really going to be devastating. Now, something else that I think is going to happen is, or which is already happening. So because the FDIC has taken control of Silicon Valley Bank, they have assured the world, or they've assured customers that they will see the deposits, or they can make those deposits, they can make them whole. So the FDIC only secures deposits up to $250,000. But in excess of $250,000, you're pretty much on your own. So the local regional bank in your area is the person who has $10 million, for example, in that bank is worried and concerned that what happens if that bank folds up, because most banks do the same thing. They invest in bonds, invest in securities. So what happens if that bank folds up? The $10 million investor loses all his money. And so what's happening now is the Treasury Reserve Bank, as announced by Janet Yellen, is saying that there are some banks that are too big to fail. I'll put an article somewhere about how this first, I think it was First Regional Bank, and how they were bailed out by some major banks. And the truth is that some banks are just going to fail, and nobody's going to do anything about it. So the average person who is banking with your local regional bank is going to take their money and they're going to put it in these too big to fail banks. And in my opinion, you might now begin to see a collapse of a lot of these banks, and will now consolidate to just the top 5 banks. The after effect of this, in conclusion, is there is I was reading this recently, her name is Lyle Brainerd. She was former vice chair of the Federal Reserve Bank, and she's now part of Joe Biden's National Economic Council. And she's a huge proponent of CBDCs. Although I did a video about this. They are central bank digital currencies. And that will now be the push. When all these banks ultimately fail, when the regional banks fail, when we have the top 5 or top 6, the Wells Fargo, the Bank of America, the JP Morgan, which are the only institutions that we have left, and the government will deem them too big to fail, and let's say one of those banks should collapse. Credit Suisse is already rocky, and is at the verge of, I don't know what's going to happen to them, then it would be an easy way for the government to just come and say, yes, we have the solution, no more banks, we're going to issue a central bank digital currency, and we're coming to save the day. And the effect of that will mean that, you can just watch this video next. Yeah, watch this video and I'll give you more information about what the effects of a central bank digital currency will be, which I don't think, in my opinion, is a good idea. Because governments are great, but as individuals, we need to start worrying and protecting our own financial future and not waiting for governments in any single way. What can you do today? First thing you can do is, I think, pay off debt. I read this book, or reading this book, one of my favorites. I know some people might disagree. His name is Dave Ramsey. It's called The Total Money Makeover. You know, pay off your credit cards, pay off debts, and then be in a position where you can buy, I'm not a financial advisor, I'm just some guy on YouTube, but where you can buy assets that can protect you. Maybe you can invest in stocks, in bonds, in mutual funds like he recommends. Please talk to your financial advisor. I am not a financial expert. This is just my personal opinion. Start to protect or study how you can protect your own financial future.
How hot is it? It's turning cold. Existing home sales falling in March, but at least in part because there just aren't enough homes to buy.
Usually it's always during an election year. In 2008, when Bush was handing over power to Barack Obama, during that election year, that's when we had this whole housing bubble. And there was also mortgage-backed securities. My personal opinion is that this next presidential election, or this next handover in the US between Biden and maybe who might be him, might run the second term, but I just believe that, or it might be somebody else. But I believe that during that period, we might see the after effects of a lot of things that are happening today. So protect yourself, invest in your financial education, pay off as much debt as humanly possible, and begin to be in a place where we can ride out this interesting journey. And I don't give financial advice, but I like investing in assets like paper is great. I like crypto. I like investing in Bitcoin. That's just my personal opinion. Gold, silver, and anything else that makes you comfortable. Real estate, art, whatever it is. But protect yourself, invest in your financial future, pay off as much debt as humanly possible, and just enjoy the ride of what's coming on next. So, watch this video next. I talked about some Sam Bankman-Fried. You can have more details about that Fried in this video here. My wish for you is that you learn more about crypto, because crypto is changing and will change the world. And those who get involved early, in my humble opinion, will greatly impact the future. And if that's you, let's go change the world.
Still looking for ways of earning extra income? Clicky lets you earn by sharing content you normally would have with friends. Go to www.clicky.com and register a new account. Now you can start earning easily. Find out more about Clicky on any of our social media handles. Clicky. Create, share, earn.